welcome everyone to another episode of the NextGen podcast series. My name is Yamil Haidar, and I will be your host this evening. I'm a financial intelligence officer with U.S. Century Bank for the last 8.5 years, and I'm also the co-chair of the NextGen Committee. Our mission statement is very simple. We look for young professionals in the compliance industry, along with related industries in the United States, but more specifically, South Florida. This evening, we're going to have the pleasure of hearing from Pamela Clegg, who is an cryptocurrency expert. Ms. Pamela Clegg, if you could go ahead and give us a quick introduction of yourself.
Yeah, hi, my name is Pamela Clegg. I'm the Vice President of Financial Investigations for CipherTrace. For those that don't know CipherTrace, we're a blockchain analytics company. We are headquartered out in Silicon Valley in California. I've been with the company for over 3 years, living and breathing crypto and crypto investigations and training and regulations, everything that has to do with crypto AML. Prior to joining CipherTrace, I spent 2 years in the banking sector as the BSA AML officer for a large community bank in Texas. And then prior to that, I spent a decade with US government, mostly overseas, mostly counter-narcotics and counterterrorism focused.
Excellent. So without further ado, we'll get started. We've seen the cryptocurrency world and industry really explode in the last 5 years, I would say. We're seeing more companies adopt retail payments for crypto. We're seeing just regular everyday people using it as an investment. With that being said, can you give us a quick overview of the crypto market, how much it's grown the last 5 years, and the market cap that it currently sits at?
Yeah, sure, absolutely. So current market capitalization today is $1.7 trillion. Now that includes all cryptos, right? And this source for this is CoinMarketCap. CoinMarketCap is a pretty well used website that just gives market updates and market overview. Overall, we're looking at 17,000 plus cryptos. Now those are based on liquidity pairs. So those are going to be, your crypto Bitcoin pegged to Ethereum or Bitcoin pegged to US dollars. So looking at liquidity pairs, you're looking at over 17,000. And then when we talk about volume, I think that's where we get into some really interesting numbers. Market capitalization kind of gives us this big, broad stroke overview. But when we talk about 24-hour volume, we're looking at 62 billion today, somewhere just north of that $60 billion 24-hour volume. So that really tells us, how much is being moved and how much is being circulated in that 24 hours.
Very good. So I think a few years ago, some of us in the compliance industry had some doubts if there was cryptocurrency in our institution. I think based on that statement and based on the sheer size of the market cap and how many transactions flow in and out daily, that's no longer a doubt, but a fact, right? And it's really up to us to start looking into it and kind of peel back the layers and really start digging for these cryptocurrency transactions and really flag them correctly in our systems. In addition to that, we're starting to see financial institutions sort of take a right step towards cryptocurrency transactions and somewhat of a regulation when it comes to cryptocurrency. We've seen FinTech come out with a number of notices in regards to virtual assets. Most currently, we saw the IRS come out with a disclosure form for virtual assets. So, my general question is, how can a financial institution mitigate the risk posed by cryptocurrency? How can they see that? What role do they play in this crypto world that we're seeing?
Yeah, that's a really important question. So I think it's important to know, crypto has been regulated since 2013, right? The initial guidance from FinCEN came out in 2013. We have seen some updated guidance as far as what banks can actually do with crypto come out from the OCC. Though there were 3 interpretive letters that came out in 2020 and then in January of 2021. We had another interpretive letter from the OCC in November of just this past year, so November of 2021 as well. The OCC says banks can engage in stablecoin use, banks can hold reserves for stablecoins, and also banks can custody crypto. Now, that is obviously banks getting directly involved with cryptocurrency. If your bank has not yet decided to take that path, understandably so, right? Although I would say most of your top banks are exploring the use of stablecoins and crypto custody. So that do understand, the way the tide is moving. But even if your bank is not directly engaging with cryptocurrency, you still have these intersections, as you mentioned, Yamil, right? So this $1.7 trillion market capitalization, the way that we move in and out of the crypto ecosystem generally falls on the shoulders of traditional financial payments. Okay, so if I want to buy, for example, a Bitcoin, which today's price is around $43,000, $44,000, the way that I actually get my fiat, in this case US dollar, to a Coinbase or a Gemini to buy that Bitcoin is I'm going to use traditional financial payment rails, right? So I'm going to use a wire transfer, an ACH. They're going to draft it on my bank account. Maybe I can use a credit card. Any of those other types of payment methods are what we're using to do what we call on-ramp or off-ramp in and out of the crypto world. And so all the banks have these intersections, whether they like it or not, because if you look at the numbers of people that are investing in crypto, owning crypto, using crypto in some way, it just goes without saying that you have at least one customer or many customers at your bank that are engaged in cryptocurrency in some way or another, and they are buying and selling that crypto using their funds from their bank accounts.
So you mentioned stablecoins.
Yeah.
A few of our listeners, I'm not sure if they're too familiar with them, myself included. So can you give us a quick overview of stablecoins, what role they have, how they're different from all the other tokens?
Yeah, so let's talk about stablecoins because they're a really interesting use case, especially with the way that they are already impacting the banking sector and the way that they're going to impact the banking sector. So a stablecoin is a type of cryptocurrency. It's technically a token, but we call them stable coins instead of stable tokens, but they're technically a token. They offer price stability, right? So one of the biggest complaints about Bitcoin, and we've heard people say this even up on the Hill, right, is the volatility. Oh, the volatility of the price of Bitcoin or the price of any other crypto that's out there. This speculative nature of these. So stable coins aim to take out that factor. They are pegged to some type of external value. In the case of stable coins, really with regard to banks, we are focused on the stablecoins that are pegged to the US dollar. What does that mean? That means that one stablecoin like USD coin or like Tether or like Gemini dollar, one of those coins has the value of $1. And the way that they are able to secure that value is that the stablecoin issuer keeps dollar reserves that equal the amount of coins in circulation. So for example, if we talk about USD coin, as of today, USD coin has 52 billion USD coins in circulation. That means that the Center Consortium, who backs USD coin, which is backed by Coinbase and Circle, that means that consortium must have $52 billion in reserve in some form, whether that's cash reserves or whether that's commercial paper, that's to be determined, right, by the consumer, which is one of the challenges of a stablecoin, but they must have those dollars in reserve to peg to each one of those stablecoins in circulation. And then those coins are used for payments. They're used to move in and out of different protocols. They're used whenever investors are moving maybe from one DeFi platform to another one, and they need to be able to move with the stable value. They don't want that value to fluctuate while they're, moving to a different protocol or they're engaging in some other investment or something of that nature. And what's really interesting about stablecoins, and I think this says a lot about where we're going with stablecoins, is, the most circulated cryptocurrency out there is not Bitcoin. The most circulated cryptocurrency out there is actually Tether, which is the leading stablecoin, 78 billion or so Tether in circulation. Okay, so when we look at Tether, its 24-hour volume, it's $50 billion as of today. Was its 24-hour volume, 50 billion in volume, whereas Bitcoin was only 20 billion. Right. So Tether is usually at least double the circulation that we see with Bitcoin. So I think that's really important to understand that circulation of Tether is not for investment or speculation or anything of that nature, right? It's pegged to the dollar. It's being used for all these other applications, being used for payments, being used for DeFi, it's being used to purchase, maybe NFTs, things like that, other features out there, other decentralized applications that are useful.
Very good, very good. There's a couple of terms there that I want to go back to. One of them being DeFi. right? I think it's really important in our financial industry to kind of understand for our listeners. So if you could just give us a 30,000 feet overview of what DeFi stands for, how it is, and how it's related to the financial industry.
Sure. So DeFi stands for decentralized finance. And what it aims to do is to recreate traditional financial systems like lending, borrowing, banking, insurance with self-executing crypto contracts we call smart contracts, right? So what it aims to do really is to take out that human bias, that human interference, and that human slowdown that we tend to have in financial systems. And it really just speeds it up so that you can now create things like flash loans, where maybe I just need a loan for 24 hours, or maybe I just need a loan for an hour. So you can create, you can get a flash loan, you can do lending. And when I say lending, we're not paying out interest every month, we're paying out interest every minute, or maybe we're paying out interest every block, every time there's a block added to that respective blockchain, or however that protocol is set up. So there's a lot of really interesting things that are happening in the DeFi space. And one of the things I think that is really having an impact on the banking sector when it comes to DeFi, number one, is DeFi is able to, it's not beholden to the Fed, right? It's not beholden to the Fed when we talk about interest rates. So I can go out to Gemini, a cryptocurrency exchange based in New York. I can, give them, $200,000, convert that $200,000 into, say, Gemini dollar, which is their stable coin. And then I can tell Gemini, I want to enter into the Gemini Earn program, which basically means I'm willing to lock up that money for, a certain amount of time. And Gemini will turn around and take that crypto out to the DeFi world, and they will be able to pay me up to 8% APY. Doing exactly what banks do, right? Banks take our deposits and then they turn right around and they loan money off of those deposits. That's how banks make money, right? The primary way that banks make money. Same concept. Gemini is functioning as the bank here. They're taking my money, they're converting that into a crypto that they can then use out in the DeFi space. And then they're going out and they're earning me 8% APY as the customer, as the holder of those funds. And so that's something that we really see impacting banks right now. Just because, banks are beholden to the Fed interest rate, and obviously the interest rate right now is still on the floor. So, I could keep my money in a bank earning, less than 0.5%, or I could take it out to, one of these exchanges. Some exchanges pay all the way up to 14% APY. It just depends on how risky you're willing to go. Or you can go very conservative. Coinbase's numbers are very much more conservative, down around 4%. But you kind of have, less risk associated with that.
You mentioned Gemini and you mentioned Coinbase. I think as compliance individuals, we've seen a lot of those brokers and transactions with those brokers. Based on your experience, and again, as much as you can share, what brokers would you say that are out there that are, the more reputable? I know Coinbase is very good with law enforcement and things like that. Is it the US-based brokers? Is it the ones that are, in other countries? What would you say about the brokers?
Yeah, so I think it's really important to understand. It's a really great point. Identifying these transactions in your payment rails is step number one, right? Number two, like you said, is, okay, now I see these payments going to a Coinbase, or I see these payments going to Gemini. How do I risk rate this? How do I assess risk associated with those payments? Number one, the number one thing I always say is, first of all, is this within expected behavior? Is this within the expected financial means of your customer, right? So that's number one. If your customer makes, minimum wage, and here they are sending out, $10,000 a month to Coinbase or Gemini, well, that doesn't fall within the expected behavior or the expected transactions for your customer. So that's red flag number one. But if it does fall within your customer's, financial means, and this is something, okay, yeah, sure, they have the disposable income to send, $5,000 a month to Coinbase or 10 grand a month to Gemini, what have you. Then let's look at the exchange that they're choosing to use. I like to call these exchanges the bridges. These are the bridges between the fiat world and the crypto world. So which bridge is your customer choosing to use, and why? How safe is that bridge, or how risky is that bridge? There might be a reason why they're picking a riskier bridge, because maybe that particular exchange will kind of let them get away with more in the crypto side, right? Once they buy the crypto, then they can go off and do stuff on dark markets, or they can go off and do, more criminal activity because maybe that exchange doesn't care. Now, exchanges within the US that either are based in the US or just even serve US persons as customers, right? Offer services to US persons are required to register with FinCEN. They have to register as a money service business with FinCEN. And if you are a registered money service business, obviously, then you have to maintain an effective AML program and report your suspicious activity and all that kind of good stuff that's required of an MSB. One of the other key factors that I like to look for, and this is all publicly available information, I'm not giving you anything that you need proprietary tools to do. But another thing you can do is go see if that exchange is registered for 314B, right? Because exchanges can register for 314B. So are they registered? Which means if they are, then they welcome communication from other financial institutions, right? They are open to actively working through compliance issues or discussing suspicious activity, things of that nature. And I can tell you, the Coinbases, the Geminis, the Bitrexes of the US, they are registered for 314B, and they do have those communications. And then, their compliance teams. We've seen numbers out of FinCEN on the number of SARs and the increase in the number of SARs coming from crypto MSBs, right? And they are really stepping up their compliance programs. They do, as an MSB, they do have examinations, right? They fall under, the IRS. Small business does the examinations of our MSBs. So they do have regulatory obligations. And most of the ones in the US do take those necessary steps. Now, overseas, crypto regulation, to put it mildly, is uneven around the globe, right? We do have FATF, Financial Action Task Force, that has put out recommendations. They put those out in June 2019 for virtual assets. They updated them just this past November. But those are, again, recommendations. It's FATF, right? What they do is they recommend regulatory requirements and rules around the globe. But there are still lots of countries where there is no crypto regulation whatsoever. And so it is a bit of a mixed bag when it comes to looking at exchanges overseas, or if your customers are sending money overseas to overseas exchanges.
Very good. I think you touched on a very good point. Financial institutions should definitely seek out 314B communication, right? So it's something that FinCEN has stressed, and other regulatory bodies, for us to kind of utilize this communication service that's out there, to reach out to Coinbase, to reach out to other exchange brokers, and really gain more information. You'll be surprised. We've gotten some feedback from law enforcement how thorough of an investigation a broker like Coinbase is, and how much information they're able to obtain from the customers and share some of that information. So that's a very, very good point. Pamela, shifting a little bit to another maybe 3-letter word that a lot of people have heard but don't know what it means. Can we talk about NFTs, right? What they are, what they stand for. There's recently been cases of NFTs being used for money laundering. In your experience of what you're seeing out there, what can you tell us about NFTs?
Yeah, I would say in the NFT world, what we've really kind of seen is more of like a wash trading, or more of a almost like a pump and dump situation. So that really falls more under the SEC as far as enforcement. A pump and dump would just be, hey, I'm going to drive up the price on this NFT by generating interest or having lots of people buy it, but really it's just me buying it, and kind of faking this interest or faking this desire to own this NFT, and then eventually somebody else buys that NFT at an inflated price or something of that nature. But really for NFTs, FATF did come out, and FinCEN is still under, has mostly agreed with FATF. In that update that I mentioned that FATF just put out, they did say that NFTs are not generally considered to be virtual assets unless they are specifically being used for payments or investments. So, if you go out and you buy an art piece, right? If you buy one of the gorilla ones or something like that, you want to buy a piece of art, NFT art, that is not going to necessarily fall under virtual currency, virtual asset. And I would say one of the other things that banks really just need to pay attention to is, are your customers able to buy the NFTs with fiat, or are they actually going through a platform like OpenSea where they already have to be in crypto So then they're buying crypto somewhere else. You might not even know that your customer's buying NFTs because they may be going to, say, Kraken exchange and buying the crypto and then going out to the platform and then purchasing the NFT with crypto. So, banks aren't necessarily expected to know for sure that their customers buying NFT. The only exception there would be, again, if an NFT platform is allowing customers to on-ramp to buy directly with fiat, like maybe a credit card or something of that nature, that would be really the only intersection that we're currently seeing.
That makes a lot of sense. I think as compliance professionals, we see these terms and their industry is moving so quickly, and we're like, did we miss something? Should we go back and see some information? Based on our experience, we are seeing transactions with certain brokers. They're reputable brokers, but you're absolutely right. It is something that's ever evolving, and it's something that is subject to change. As far as the due diligence, just be, if you have a customer that's purchasing NFTs, do your due diligence. Try to look for market research. Try to see if the price is commensurate with the actual amount of the wire or the transaction. Again, it's a little bit easier said than done because you could run into the risk of overpricing and underpricing for money laundering. But I think that's what we could do for what we have at the time. Pamela, just to kind of bring everything together and kind of wrap up all the information that you've given us. I know that you're familiar with regulators. I know you provide training to some of them. Where do you see the compliance industry in the next 5 years as it relates to crypto? What do you see regulation heading? Are we at the beginning stages? Are we in the middle? Are we in the tail end? Can you share us on that?
Yeah, well, I think it's really important to understand where we are on the timeline. That's a really good point. So, this whole concept of the modern cryptocurrency, starting with Bitcoin, kicked off in 2009. And here we are in 2022. So we're really, a lot of people, you're going to see a lot of, if you go out on the internet and you Google, you'll see a lot of people compare it to, the early phases of the internet. What was the internet like when when we were, 12 years in, 13 years in, compared to, crypto, here we are 13 years in. So, what have we seen as far as use cases? We definitely kind of have seen similar evolution. When you go back and you look at the 2013 timeframe, you look at the 2014 timeframe of crypto, there was definitely a more nefarious perception of it because of Silk Road and because of the uses on, dark markets and all these other kind of use cases that have been out there. And then, as we saw with the internet as well, we see this kind of adoption, and we see this acceptably. We see other use cases come up, other use cases that really make a lot of sense, like payment settlements, things like that we see with stablecoins. I firmly believe, and the Fed really kind of highlighted this a little bit in their report that they just put out a couple of weeks back, that stablecoins are definitely going to be the payments of the future. And this is going to be for, to replace things, think about wire transfers, think about, micro payments, things of that nature, where that's going to go cross-border remittances of the use cases that are out there for cryptocurrencies like stablecoins. Right now, we're just seeing a huge clamoring for training and understanding from the banking sector, right? So the banking sector wants to understand this technology. They want to understand the impact that it's having on their institution. And then they want, just like you said, they want to start to see where this is going to go and how they can really get themselves prepared for it. I would say, as an AML professional, definitely at least start to get the basics down, right? Get the basics, understand, because, once we have the top, 20 banks, the top 25 banks using stablecoins, that's going to trickle down. And it already skipped, right? One of the well-known cases right now is USDF, USD Forward, which is a stable coin that New York Community Bank and other banks, Sterling Bank, there's a consortium of banks that are in on this stable coin. They've already gone out and created their own stable coin, right? And they're not top 25 banks. They're, smaller banks, but they were like, hey, this is where we need to be. This is the vision. This is the future. So they've already done that. They've already kind of jumped the line, and they're already in that. And I've also heard the same requests from, again, smaller community banks as well. Hey, we want to maybe create our own stablecoin, or maybe we want to adopt a stablecoin, but we're definitely looking at this, and we want to bank digital assets. So it's, and that's from asset size of $1 billion all the way up to, to our top banks in the US. So it's really having an impact on everybody. So number one, again, is education. Make sure you're getting educated from a reputable source. And I say this as an AML professional, but also as a crypto professional. So, if you want to learn crypto, go to the crypto people. That's really, we can talk about AML red flags all day, but really it's important to really have that tech explained to you in a way that is digestible, in a way that's understandable. And I definitely would recommend seeking out those resources. The exchanges have good resources. Most of the exchanges, Coinbase and Gemini, have like learning centers on their websites. And then of course, blockchain analytics companies like CipherTrace, as well as the others that are out there. We're not the only game in town, but we all put out, crypto AML reports or quarterly reports or just kind of updated reports on, financial crime and crypto. Those are all free. You can download them from, all of the respective websites. So those are all really good resources for kind of just getting up to speed.
Excellent. Very good. I think we touched on a lot of points. There's a lot to unpack there. But unfortunately, we don't have enough time to kind of go through everything in detail. I do want to thank you for your time, Pamela, also other associate for FIBA. If you have any key takeaways or any final thoughts, go ahead and share them now.
Yeah, just don't be scared of it. Once you get in and kind of start to understand it, it's just, it's just evolution and change. I saw an expression the other day, embrace the happiness that change can bring. Right. So embrace some of the good positive pieces of crypto, which is, traceability, the ability to trace original source of funds and to look at the destination of crypto a lot more effectively than you can do with fiat. So there are definitely positives. Don't, just be open-minded about embracing this new technology.
Excellent. Thank you again. And I think that wraps it up for today.
Great. Thanks, guys.
Good. Pamela, thank you so much. And Diana, as soon as Tanya has the questions and the answers to those questions, we'll send it all over to you guys.